All right, I can see we have some people joining here, so we'll get Brett started here in just a few minutes. Steve from Morningstar is joining us as well. Good morning, Steve.
Good morning.
How are you
Good morning.
today?
I'm well. How are you?
Good. We're going to let a couple more participants jump on here, and then we'll let Brett get started here.
Okay, great.
So as a reminder for everyone joining today, we are talking about ESG investing. So Morningstar has done a lot to help expand that. So one of the reasons that we've partnered with Morningstar is their commitment to research and kind of looking behind the curtain to see what's really behind funds. And with some of their investments that Brett will talk about here, over the last couple of years as a company and the research that they're focusing on, they're helping look behind the curtain of ESG investing. So you might say, okay, Josh, but what is ESG investing? Well, don't worry. Brett's going to take care of all of that today. He's going to give you a high level view of what ESG investing is, how Morningstar managed portfolios has some solutions, if that's an area that you are interested in, and talk about some of the common criticisms that ESG investing or this trend has received. And if you say, okay, I've heard of ESG investing, but I'm not really sure that that's for me, that's certainly okay too. But I want to make sure you are aware of it because it's a growing trend within the industry, which means if dollars are going there, there's an opportunity for a return for you. So if for no other reason, I hope that you listen up today and participate. Feel free to ask questions along the way and hope that you gain something that helps make your financial picture better. And with that, I'm going to turn it over to Brett, and I will mute myself. Brett, welcome.
Thanks, Josh. Thanks for having me. Good morning, good afternoon, everyone. I'm Brett Greenspan. I'm a portfolio specialist at Morningstar Investment Management, and Josh gave a really good introduction there. So, as you've heard, as you're seeing in the news, ESG is really front and center for a lot of investors. It's certainly picked up a lot of steam over the last couple of years, the last 3 years specifically. And so today, I put together a presentation, and really, I'm going to cover a few different topics for you. And it's going to start with really just kind of an overview about sustainable investing, some definitions, trends, where things are right now, where they've been, where they're perhaps going. And then I'll talk a little bit about the partnership between Morningstar and Sustainalytics, where Sustainalytics is really a leader in ESG research, and Morningstar recently acquired them. So combining two research powerhouses has really been a huge change for us, and really puts us at the forefront of the ESG space. And then, as Josh mentioned, we've got a couple solutions in-house here. And I'm going to go through them at a high level. Really, it's more just to inform you about, we're talking about ESG definitions, ESG research, what the output of that looks like. So just kind of give you an idea of what that is. If it is something that you're going to be interested in, I think it's helpful to have an idea of what that looks like, how it's constructed. And we'll have plenty of time for Q&A at the end. But if there's anything I'm going over, you feel like interrupting, by all means, I could use an interruption. There's a lot of slides here. So if you feel like jumping in, don't hesitate. Happy to take questions as we go. So let's start off talking about sustainable investing at a really high level, kind of definitions, where we started and where we're at now. And if you're anything like me, it's a little bit overwhelming. There's this alphabet soup of definitions and names. It started as responsible investing, socially responsible investing, green investing, sustainable investing. It's overwhelming. Investing is complicated enough as it is. And so really what's happened over the last few years is the industry has tried to come up with more of like an industry standard for how we're defining sustainable investing. And it's taken the form of ESG, but in the sense of what that means, if we're defining sustainable investing, it's talking about investment approaches that integrate ESG criteria into their process while still trying to generate competitive long-term financial returns, right? So they want to have a positive societal impact, but these are investment funds. These matter. These are potentially retirement savings. It's important that they also are delivering those long-term financial returns alongside with that value investing. So what you're looking to do here is invest with your wallet, but also, factor in the concerns about ESG risks, about the impact that your investments are having on society. And really, this change is just reflecting a broader shift about what sustainability is. We want to make sure that that if we are trying to invest with our values, that it's actually going to have a positive impact. And that's something that we're going to touch on a bit later. How impactful is it? Is this going to make a long-term change? Is this properly incentivizing businesses? And that's really the key to this is, obviously you're investing in a multinational company. How much can in sustainable investing incentivize those companies to act responsibly moving forward? So a roundabout way of getting to what we're now calling ESG investing. This is environmental, social, and governance. And really what this is are non-financial factors that are affecting a company's bottom line. It could have material risks. So material meaning a detriment to the share price. And then really they fall into these three buckets. So there's the environmental bucket. So what is the impact of this company or this fund perhaps are having on society, on the environment? And I'll give you an example here. I want to give you an example for each of these. I think it helps tie it together. Think about British Petroleum, the BP oil spill back in 2010. A huge issue, right? The one that we're frankly still grappling with today. That would be something that we'd say, okay, this is having an extremely negative impact on the environment, so their risk score would be way higher. When you talk about that S, the social aspect of this, labor standards, supply chain, diversity management, Nike is a great example here. If you think about the late 90s when they were having some issues with their labor standards, that was something that, at the time was huge news. And I'll actually note that Nike is a great turnaround story. They got a ton of bad press about that. There were regulations imposed. Nike's actually come full circle and is now a part of our U.S. Sustainability Moat Focus portfolio. So they've actually had a complete turnaround from that standpoint in their labor standards. Governance, so looking at board structure, executive compensation, certainly bribery and corruption issues. Think about Volkswagen here. Volkswagen had the emission scandal. I think that was a couple years ago now. And if you'd looked at their governance leading up to that, their controversy scores as assessed by Sustainalytics, it was pretty evident that they weren't being managed efficiently up to that point. And so I think that's a good example of saying, okay, we're assessing risks here. Maybe there's nothing that's come of it, but over a long enough time, perhaps that was a risk that you could have seen coming if you were ESG inclined. So just wanted to give you a bit of a sample about what we're talking about when we say ESG now. This is the industry standard. You'll still see funds that say, responsible investing or sustainable investing, but really they all now fall under that bucket of ESG. So when we're looking at these funds, whether it's a mutual fund, an ETF out there, there's a number of different ways that we can assess their commitment to ESG. Now, on the low end, you'd say this is a fund that considers ESG, right? So maybe they've got one or two lines in their fund prospectus that says, we incorporate ESG into our process. Now, that's fair. That's totally fine. Not everyone needs to be a fully implemented ESG fund, fully integrated. But what we're looking for when we're managing an ESG portfolio or looking for investments that score highly here, we're looking for a bit more than that. That falls more into that bucket of kind of greenwashing, which you may have heard of or funds trying to add, an ESG tilt to their name or an ESG line in their prospectus so that they can participate in a lot of the increased interest we're seeing in ESG right now. What we're looking for is more of those next three, that ESG integration. So funds that are fully and actively integrating ESG into their process. So whether that means they've got an ESG team that's assessing risks, or they're partnering or leveraging Sustainalytics to conduct ESG research when building their portfolios, we want to see an actual integration of ESG into their process. One level up from there would be an impact focus fund. So they're not only tilted toward ESG, but they're actively working with stakeholders, to move forward ESG issues, whether that's stakeholder management or whether that's actively reaching out to other stakeholders to try and drive some of these issues forward. It's not just integrating ESG into their investment and research process, it's actually trying to have an impact. Then the last one would be sustainable sector investing. So actually actively investing in some of these, call it green economy industries. So renewables, energy efficiency, environmental water services. And it could even be one-offs from there, companies that are supporting those industries. But really, this is where it's not just incorporated into the process, it's actively investing in those sectors, in those industries.
Brett, I'm going to jump in for 1 second. We did get a question from Harry. He said, how can a company manage the need for low labor costs versus social responsibility? And a good example, or he was saying like in your example of Nike, I think another timely one that maybe you can tie into this response would be Amazon as well. I know with some of the severe weather we've experienced here in the Midwest, there was some tragedies associated with warehouses, and I believe a candle factory as well, unrelated to Amazon. But how do you manage that social responsibility versus the need for low cost and low skilled labor? I think
it's a great question, and that kind of gets to the core of, I suppose, maybe skeptics is too strong, but the core of the issue between these companies that have a fiduciary duty to look out for shareholder interests, right? To ultimately, do what's best for the bottom line, and managing that with the needs of ESG and labor standards. So really, it's a great question that I don't think there's a black and white answer to, but a lot of these companies that you're seeing are understanding that this is important not only to consumers, but their employees as well. Consumers want to invest. You'll see in a couple slides here, I've got a study that shows consumers are driving these issues with their wallet, right? They want to buy products from companies that they think are just. They want to work for companies that they think are just. And so ultimately that is, I think the idea behind this is that they're incentivizing these companies to act in that way. So that's always going to be kind of the, where is the middle ground between keeping costs low, because that's what is ultimately going to benefit shareholders, versus providing a living wage, providing good labor standards so that employees, can benefit from that, and so that they can ultimately feel that they're, acting in their best interests.
So I don't want to get too off topic here, but would you say that sort of that brand loyalty or that strength of the brand maybe comes into investing factors outside of the actual dollar? So brand loyalty, maybe helping build a moat or something like that with the company as well.
Absolutely. Brand loyalty has been around forever, and I think that's another aspect that maybe is getting too far in the weeds to talk about marketing and analytics for how much can we charge before our brand loyalty diminishes. But I can speak personally and say that I get these socks called Bombas. Bombas they're these great socks that I have, and they're kind of their pitch is that for every pair you buy, they donate a pair. And I like that. I'm willing to pay a little bit more because I think that I want to buy products from a company that's thinking that way. And so that's just a piece of personal experience. But I think that's the idea, is that consumers are ultimately willing to be a little more loyal if they feel like they're going to have a positive impact, as opposed to just only voting with their wallet.
Okay, fair enough.
Josh, if you don't mind, I want to pinch in real quick on Harry's question, because it's a good one. We didn't see that balance before. It was always about shareholder interest and not necessarily employees. As we've seen in the last 2 years, there's been a lot of increase in awareness on wages, livable wages. So some of the companies that are in our ESG portfolio for equities are like McDonald's, are Starbucks, are those companies that we've seen a lot of press that they want to pay $15 an hour or more. So those are two companies in the portfolio. I don't know about the Mayfield, unfortunate that tragedy in Kentucky. I don't know about that company per se, but the companies that are the companies that are going to be, probably looked at and entered in these portfolios.
Yeah, and I know, with Amazon, I think it might be a $15 minimum for the warehouse workers. That's quite a jump from maybe a couple years ago when maybe those wages were around $10. for those jobs. I know that that's part of the friction in the economy now.
Yeah.
So maybe just working in the same question, do we see some of these social pressures kind of mounting quicker over the last 2 years with some of the social unrest that we've had?
I think that's an obvious yes, right? I mean, for better or worse, companies don't make these changes on their own, or the ones that do are few and far between. It requires some social pressure, to ultimately reach a point where companies feel like they have to do something here because they can't withstand the pressure. It's bad for maybe it's bad for their brand. Maybe they're seeing it actually affect their bottom line with sales going elsewhere. But I think absolutely we've seen, kind of a number of companies, a number of huge corporations feel that pressure and make a change over the last few years.
Okay. I'm going to throw another one in here that Michael just submitted as a question, but he had noted that Dick's Sporting Goods, which in Pittsburgh is a hometown company, it's also a significant company for us as well, but that they've tripled over the past 3 years. And he particularly notes that he had bought it when they removed assault weapons from their inventory, what they're selling in their stores. I know, and this is not a political issue or discussion around guns rights, but clearly some people, especially with a lot of the violent incidents that we've had in the United States, feel that is something that maybe we need some more roadblocks up. So a very well-known sporting goods store like Dick's, by them removing it, I think that's a pretty big statement on their part. And I think Michael's seeking to know, do you know, how that growth kind of relates to that behavior? Or maybe you could talk more in general, or say, I'm going to get to it, of how we can see that when reviewing a company to see the financial impact of it.
Yeah, that's a great question. I feel like I almost owe Michael a little head nod here because he teed me up nicely for my next slide. But I think that's something that, over the long term, perhaps it would be easier to say, in the second quarter of 2020 or 2021, they no longer sold, weapons in their stores. And, based on in the following 4 quarters, their revenues increased by X, and specifically in the areas where there were big gun sales. So there would be, I think you could quantify it, but there would be a number of different variables based on location, based on existing sales, based on other products that they're replacing it with, that might make that a bit more of a heavy lift. But absolutely, that's again, this is a hot topic, so I have no position to take on that. But I can tell you that it's something that is important to ESG investors and certainly those with value preferences. That weapons production, weapons involvement is something that is screened out often. That's something that in our U.S. Sustainability Moat Focus portfolio, our ESG SMA. Product involvement with weapons production is one of the screens there, and I don't think that's an uncommon thing when looking at some of these funds that are more values inclined. But as for the kind of input output of making a change like that and the output on the stock price, that's something that it's harder to say. We can draw a direct line between them.
Josh, I'll just say this: I live in the eastern part of the state. I did not know that about Dick's Sporting Goods, but I know they're a well-run company. They have great management, and their online sales are really good. Because I'm a rewards member, and I get constant emails from them, so I know they have great management and a good online presence. So I'm sure with COVID that really helped their sales as well. So yeah, they're the perfect company though for an ESG portfolio, because we look for strong management. I mean, it's not just about ESG. There has to be a combination of ESG, good ratings, as well as competitive advantage. Company needs to be good. And I think Dick's hits, they hit that note.
Well, and I think maybe, and this isn't meant to be a focus group on Dick's Sporting Goods either, but there was a period in time when their stock was not doing very well. But I know in terms of community relations, which Brett also has up on the screen, for me growing up mostly in Pittsburgh, there was free water bottles that they were supplying to youth sports leagues and other equipment to kind of make sure that kids have the equipment to play sports, and they were very present in that for me growing up as well, which I think is a good member of the community. So anyways, enough on this.
All right, well, that was a great segue to where we're going here. And I just want to kind of put up this slide here and highlight, the right side, those value preferences, that's really how kind of responsible investing started. I think you could go all the way back to really religious institutions didn't want to invest in sin stocks. And so we had to build these portfolios that stripped out some of those sin stocks. And now you've got this other bucket, this ESG risk reduction, which is certainly front and center for a lot of people that are focused on climate change, and definitely for younger investors who tend to be more inclined to focus on the environment. And so there's just been this evolution where it used to be, solely excluding funds or excluding the types of investments that you want in a portfolio. Now it's a little more call it positive screening, including companies, including funds that you want to say, okay, this is something I want to support because I want to see this grow over the long term to benefit the environment, to benefit my community. Now, we've talked a lot about where the industry was and where it's going from here. And I just bring this up to highlight that there's been a huge uptick in asset managers incorporating ESG. And really what you're looking at here is a chart that goes back to 2006 when the Principles for Responsible Investment, this was a UN-backed initiative, kicked off. And at that point in time, ESG as it is now wasn't really around, but sustainable, responsible investing was around, but it was very niche. There wasn't a ton of support for it. If you think about where the market was in 2006, it was kind of a manic time for the markets, followed by a very strong pullback, a very slow fast recovery, but slow for the markets, but slower recovery for the economy overall. So there were 63 signatories in 2006. They repped about $6 trillion in assets. So that sounds like a big number, but when you hear where it is now, with the increase in ESG interest, there's now 3,000 signatories representing over $100 trillion in assets. So just about every asset manager out there has signed this Principles for Responsible Investment to incorporate ESG in some capacity. Now, again, that could be as simple as what I talked about earlier with ESG consideration. It could be, impact investing. It could be integrating into the process. But the point is that we're looking, the industry wants everyone to factor this in some capacity, to understand that this is kind of an all hands on deck initiative where we need to look after the environment, look after our communities, and incorporate this in some way. Now, naturally, given asset managers are putting that out there, you could say, okay, did asset managers come first or did the flows come first? Is it a chicken and the egg discussion here? But naturally, there's been a similar chart here that shows the increase in flows into sustainable funds. So if you go back to 2009, not a ton of interest there. We even went negative into 2011 and 2012. But really over the last 5 years, you've seen a massive uptick in sustainable fund flows. This is something that is generating a lot of interest, and it's not just interest on the news and articles. These are fund flows going into these types of investments. And based on what we've seen this year, I expect that number to increase for 2021. So again, it's not going to be a perfect solution for everyone, but the idea is that there is a ton of interest out there and they're flowing into these funds, whether it is mutual funds or ETFs or even some of these SMAs. Now, this is a chart that's really interesting. This was a study by Morgan Stanley, and I'll just walk you through here because it's a little bit busy. But it starts in 2015, and on the left side, you're seeing the general population, and it's looking at the dark blue on the bottom, which is they're saying they're very interested in sustainable investing, or the light blue, which is somewhat interested. And you can see in 2015, about 70, a little over 70% were saying that they were either very or somewhat interested, but just about 20% were very interested. And those numbers have ticked up gradually from up to 2019. But the right side, I think, is where things are very interesting. In 2015, over 80% of millennials said that they were either very or somewhat interested. Only 28%, so not a huge difference between the general population, said they were very interested. That number has more than doubled into 2019, with 70% of millennials saying that they're very interested in sustainable investing. That's a huge increase. And I bring that up because millennials are going to be the longest term investors out there, right? They're going to be the ones who are entering their prime earning years. They're going to be the ones who have, call it 50+ year investment time horizons. So it's a good indicator that this is an interest that's front and center for the people whose assets are going to continue to grow from here. They're not tapping into their assets. They're putting assets into the market. And millennials, at this point through 2019, 95% were at least somewhat interested in sustainable investing. So very encouraging numbers if you are inclined in this space, and certainly something that doesn't seem like it's going away anytime soon. So just another chart here to kind of highlight what we talked about with the asset managers. When this space started, call it a decade ago, the vast majority of the solutions out there were mutual funds. And I think mutual funds will probably always lead the way with ESG investing, given that they're actively managed, and ESG investing is perhaps a bit more intensive in the active management side, needing to understand, how is ESG being incorporated into the process? Is this fully integrated? What type of ESG investing process do they have? But it's great to see that there have been a lot of ETFs that have launched really since 2015 is when the numbers started ticking up, because these offer another low-cost solution for investors who do want to get in this space. In our ESG asset allocation portfolios, we actually use mutual funds and ETFs. So in areas where we think an active manager is going to earn that extra cost to use them, we do so. In an area where we say, we want some passive exposure here, we're not sure that there's an active manager that we want to leverage, we can still get exposure there without having to go outside of the ESG space to obtain that. So certainly encouraging in the sense that there are more and more solutions out there for investors who do want to get involved in sustainable investing. Now, another chart here, or slide that rather I find very interesting. This is a study by Nuveen. And on the left side, it says that 85% agree that they'll only invest responsibly if the returns are the same or better. And I think that makes sense, right? Nobody's going to say, I'd love to invest even though my returns are going to be worse. That's a tough pill to swallow right off the bat. But I bring this up because what investors are saying is that the top reason that they have been investing in the space was better performance. And that is a big change from where things were. It used to be that the big reason that people didn't want to invest in ESG was because they couldn't count on better performance. And that's certainly not to say that performance will always be better or always going to be neck and neck. This may, if we see underperformance from sustainable funds or ESG investments, perhaps these numbers will change. But over the last, call it handful of years, the fact that it has seen better or equal performance, and perhaps even occasionally some underperformance, but within range of a traditional asset allocation portfolio, that's a big change for the sustainable and ESG space, and it's somewhat surprising to see that at the top of the list.
Brett, would you see maybe ESG eventually becoming a factor in portfolios where maybe we seek value-based stocks or growth-based stocks or dividend payers or, smaller cap to try to outpace the S&P? Do you see maybe ESG falling into that category where maybe it leads for a period of time and then has sub-index returns for a period of time and kind of an ebb and flow there?
That's exactly right. In the same way that investors might say, I don't want to be in value because value is underperformed. They might say, I don't want to be in ESG right now because ESG is underperformed. That's right. I expect that there will be some ebbs and flows to this. The point I'm trying to make is that it now is it's no longer the hurdle that it was to invest in ESG, which it was. I don't want to sacrifice performance because that managers out there have integrated it into their process. They've built these portfolios to try and keep pace with a more traditional asset allocation lineup. Now, a couple more studies that I think help inform how front and center this is, how important it is to consumers, and this maybe ties into what we were talking about earlier. 67% of consumers are saying that either often or sometimes when they're deciding what products or services to buy, they're going to do that based on what's important to them. And 74% say that they are loyal to a company or product if they perceive that company to be just or fair. So that's what we were talking about earlier, is that consumer decisions are being led by this. Now, again, we can get into the impact of that later on, but the idea is that consumers are aware of this. They want to feel like they're having an impact when they're buying their day-to-day products. And it's not just their buying decisions, it's also their employment decisions. This same study showed that over 70% said they'd choose to work for a company they considered more fair, even if that led to a 20% pay cut, which is a pretty big number, right? But it just informs that value-based consumer decisions, value-based employment, this isn't a small majority. It's important to a vast majority of people. And one more here. This is another Nuveen study that showed that over 80% want their investment to make a positive societal or environmental impact. And that's whether that is actually happening. I think we're going to discuss here. I listened to a podcast which gets into the subject, but it's important to investors. It's something that, given the number of solutions out there, I think is going to continue to have a place in the investment universe. And the more time it's in that investment universe, the more funds, the more resources dedicated to that, the more efficient I expect it will become. So I want to talk about the partnership between Morningstar and Sustainalytics, and I'll get into the background about Morningstar a little bit later here, but we've been an independent research firm since 1984, and that's equity, fixed income, alts, currencies. We've got a huge research organization here, which we think is a pretty significant value add. We've been a leader in the space for a long time, and we partnered with Sustainalytics, who's been a leader in the ESG research space for about 25 years. We initiated that partnership in 2015. It was really just kind of a pretty logical match to make. Of we've got these significant resources, these economies of scale, but we didn't have all the ESG research and legacy research that Sustainalytics had done. So we formed this partnership in 2015. We made a targeted investment in Sustainalytics in 2017 and completed our full purchase and acquisition of Sustainalytics in 2020, incorporating them under the Morningstar umbrella. And it really has just been a tremendous partnership. Again, they've been able to leverage a lot of the holdings data, the IP that we have in-house that we've built over, call it 30 plus years. And to be able to partner with a leader in the ESG space as ESG is growing at such a rapid pace here, it's been a huge benefit to both companies, and one that we're already seeing those benefits bear fruit. Now, this is a side-by-side that kind of shows the breadth of history and research that these two firms provide. And you can see Sustainalytics, 25 plus years specifically in that ESG and governance space. Morningstar's got 20 plus years of research in that independent equity research space. And to be able to combine these resources, I think really puts us as the leading provider of ESG research out there, and allows us to leverage a lot of that in-house research to manage both our ESG asset allocation portfolios and what we're doing on the SMA side as well. Now, we're talking about ESG at a high level here. I want to show you what some of those outputs look like. And these are just kind of snippets here of what those are. If you do want to dive into this in more detail, we would be happy to provide you some commentary, a bit more of an overview about the process. But it could be a sustainability rating, so giving a globe rating to these funds about how sustainable they are. A low carbon designation, that's obviously very important to those that are more environmentally inclined than value inclined. So looking at a low carbon score. Product involvement. This ties back into what we were talking about with Dick's Sporting Goods about, are they involved in weapons production? Are they involved in tobacco? Any of the, maybe you don't want to invest in a company that is affiliated with gambling. So providing research and kind of a look through on their product involvement. And then just the sustainable attributes of the fund and a qualitative research write-up by one of our analysts. So there's a lot that goes into this, but there are a number of different outputs depending on what you're looking for from that ESG research that we're now able to provide. So I've gone through a high level ESG definitions, kind of trends, some studies about ESG. I just want to give you an example of what that output looks like. And Morningstar launched these ESG asset allocation portfolios about 3 years ago now, maybe a little bit less. And They're really broadly diversified portfolios comprised of mutual funds and ETFs. And they're custodied, or they're under the umbrella of this Morningstar Investment Management Group, which I'm a part of. We're headquartered here in Chicago, but we've got offices all over the world. We're in Australia, China, South Africa, UK, India. So when we talk about having a global investment team or global research, that's not just referring to the funds that we invest in. We truly do have a globally collaborative team. We've got just shy of 100 investment professionals working on managing these portfolios. And at the end of the third quarter, we had $260 billion in assets under management and advisement. Now, I mentioned that Morningstar Inc. was founded in 1984. That was our research arm. We launched our first managed portfolios in 2001. So we're coming up on 20 years here in the managed portfolio space. And I think having this research arm in-house is a significant value add for us when managing these portfolios. Now, I just showed you a little bit of history on Morningstar and Sustainalytics, but just to give you an idea of where we stand, where we started in the ESG space and where we are now. In 1993, this is really when I would say we kind of put our flag down. We added a socially conscious data tag. But 2015, I'd say, is when things really kicked up a notch. And that falls in line with when ESG interest was really hitting the mainstream. And that's when we formed our strategic partnership with Sustainalytics. Again, I mentioned in 2017, we had that 40% stake, that 40% investment in Sustainalytics, which we completed last year with a full acquisition. And then again, you can see that our ESG asset allocation portfolio was launched in 2019. And we launched this Morningstar US Sustainability Moat Focus portfolio. Say that a few times fast. We launched that one earlier this year on Earth Day, actually. And that's one that I'll touch on a little bit here, but it combines really call it a valuation-driven approach, a valuation lens with an ESG lens. So for those that are maybe want to dip their toes into ESG investing, they're not totally convinced on it, still want a financial overlay, that's been a really good solution out there. So these ESG asset allocation portfolios, they fall through the same lens or the same buckets as our traditional asset allocation portfolios. There's 5 different offerings ranging from conservative to aggressive. So conservative is like a 20% equity, 80% fixed income, and they go up in 20-point increments from there. But the key difference is that these portfolios are investing in mutual funds and or ETFs that are intentionally investing in a sustainable way. So you heard me talk about that earlier, intentional. That's really the key takeaway is we're not just looking for funds that fall into that ESG consideration bucket. We want them intentionally integrating ESG into their process. And you'll see how we rate that and how we score that in a couple slides here. Now, I talked about valuations a little bit. You'll have to allow me. I try to use one Warren Buffett quote per webinar. This is my one allotted quote here. And this is a great quote from 2008. And what he said is, price is what you pay, value is what you get. And we really believe that. You know, I think last year is a great example where you saw the price of the whole market moving based on tweets, based on vaccine discussions, based on, you know, new data about COVID-19. Whereas the value of an underlying business was relatively unchanged, right? It's the value of the business is the ability to generate free cash flow and manage risk. So what we try to do when we manage these portfolios at a very high level here is buy investments that are trading at or below their fair market value. We know we're not going to stick the low here. So we try to buy as they're, you know, entering a trough, exiting a trough, hold as they appreciate back to fair market value, trim, and then ultimately sell those investments. So that's really what we're trying to do at an extremely high level. Buy investments that are trading at a discount, sell investments that are trading at a premium, and build a portfolio around those constructs. Now, how does that work when you're building an ESG portfolio? Now, we've got the same process in place, right? Where you start with in-depth valuation analysis, developing views about the asset classes that you want exposure to. But now we add this ESG overlay. So assessing what are the ESG risks associated with those asset classes, with those sectors. Once we've scored those, once we've given those a risk score, so decided, okay, here's where there's more risk, here's where there's less risk. Then we go and look at the fund universe out there to say, okay, let's look at the funds that would give us this exposure and find the ones that have an ESG commitment level of basic plus or higher, right? So we want them to be integrated. We want to make sure that they're, at minimum, actively incorporating it into their process. And ideally, they'd be a leader in that space, right? So looking at the funds that are out there, making sure that they're going to fit alongside one another. And I think this one's important. We don't want to just invest in funds that have, call it, same track ESG processes. We want diversified ESG commitments or diversified ESG integration processes. We don't want funds that are going to say, oh, we all strip out, XYZ energy companies, or we strip out XYZ product involvements. We want to make sure that there's some diversification among their processes so that there's not too much correlation between them. If we do see, as you talked about factors earlier, Josh, if we do see the market react in a certain way over the long term, we want to make sure there's some diversification among their processes. And then lastly is ongoing monitoring, right? So measuring ESG, making sure that there's no change in the exposures that they have, any controversies that they might be exposed to. So that's an ongoing process that's similar to our traditional asset allocation portfolios. Now, I talked about ESG commitment levels a little bit on that last slide. And really we assess them on a 5-tier scale, starting with leader all the way down to low. And we won't include funds that have a commitment level below basic plus. That's, you can have a basic level, but that's something that, it just is, it gets, falls back into that greenwashing, which is what we're trying to avoid. We don't want to work with funds that are just trying to soak up assets based on the interest from investors out there. We want to see them actively involving this in their process. So when we're looking at a commitment level, we've got 4 different buckets here and we weight them differently, right? So process is the most important. I've gone into this in a ton of detail already, but really it's just incorporating that into their process. Then we get into resources. So do they have people committed to ESG in their process? So, in their company? Do they have a dedicated ESG research analyst? Do they have a team that's focused on assessing this? Are they, simply outsourcing this to another company? That might be a negative indicator for us. And then, in terms of the data they're devoting to their resources, we want to make sure, are they actually, maybe leveraging Sustainalytics or perhaps a competitor out there in terms of the data that they're using. And then, lastly, is the parent company. This is weighted less because we don't want to ding a company that maybe is launching an ESG fund that we like, but are under the umbrella of a company that's not ESG inclined, right? So it's helpful if the parent company does have an ESG focus or is committed to ESG, but ultimately we don't want to ding a fund too much if the broader company that they work under isn't incorporating ESG at the level that they are with respect to their fund. So just a quick sample here of some of the funds in here for those of you that are familiar with ESG investing. Probably some familiar names that you recognize here: Parnassus, Calvert, Domini have been leaders in this space. You'll notice on the fixed income side, you see those U.S. treasuries in there, some government bonds. That's really from a governance perspective. These are backed by the full faith and credit of the U.S. government. So from a governance standpoint, those are a good fit in the portfolio. Now, what's the output like? We've talked a lot about what goes into the process. How does that lead to better outcomes, or how does it lead to a reduction in risk? So what you're seeing here is the portfolio. This is our ESG aggressive growth portfolio versus its custom benchmark. And you can see, this is what you'd like to see, right? Which is less severe ESG risk, less high ESG risk, more medium, low, and negligible ESG risks. So it's never going to be perfect, especially when you're investing at the fund level. There's going to be some exposures in there that perhaps you don't want, but ultimately what you're trying to do is limit those exposures. And the same goes for controversies. You want more companies, more funds that have no, low, or moderate controversies, less than have significant high or severe controversies. So it's working as intended. As I mentioned earlier, this is something that is going to get more efficient with time as we have more resources out there, more funds available, more screenings involved. This should, again, ultimately, hopefully, these numbers should continue to trend in the right direction, but certainly how you'd want this to look after a few years of inception here. Now, last thing I'll touch on is our sustainability moat focus portfolio. This is comprised of individual equities and it invests in companies with a lower carbon risk and controversy score. So I mentioned earlier, It does exclude companies with involvement in certain products, so production of controversial weapons, civilian firearms, thermal coal extraction. And so this is for investors that are really trying to align their values with their financial goals, right? And I talked about that valuation lens earlier. This is only going to invest in companies with wide moat ratings. I know Steve talked about that earlier, companies that have a sustainable and growing competitive advantage. And it also looks to invest in undervalued companies, so companies trading at a discount to their price to fair value. Now, I just covered a lot of this here, but really it's combining, Morningstar's ESG focus with Sustainalytics ESG research, and then adding that valuation overlay, that wide economic moat rating. Now, here's just a quick summary of what that looks like. I'll note that this is a passive portfolio. So this tracks a Morningstar index. That's why you've got that long name there, that US Sustainability Moat Focus portfolio. 40 to 80 holdings in here, ESG risk ratings of medium, low, or negligible, lower controversy score in a trailing 3-year period. I mentioned carbon risk score earlier. So a lot of filters here, a lot of screens, but one that we think, again, if you're not totally all in on ESG, if you want to say, yeah, I like ESG, but I'm not willing to throw out financials, I want that incorporated in my process as well, this is a pretty great solution out there. And then in terms of the positioning of the portfolio, tends to be a bit more large cap growth oriented. I think you'll find that a lot of ESG portfolios tend to have maybe a bit more of a growth tilt, given that they are a little more tech heavy. A lot of that is due to the fact that those companies are less capital intensive. Perhaps they're less harmful to the environment in some cases. So right now you're seeing a lot of ESG portfolios that tend to be a little more growth, a little more tech than perhaps a more traditional asset allocation portfolio. So in terms of why you might consider a sustainable approach, I don't need to walk through these all in particular here, but if you are looking to invest with your values, whether that's purely value-based, whether that's environmental-based, there are a tremendous number of offerings out there, not just Morningstar. There, as you saw, tons and tons of funds out there. So if you do want to learn more about that, by all means, certainly reach out to Josh. And if Josh needs anything from us, we're happy to provide.
Yep.
So
Brett, I want to jump in real quick there.
Please.
Michael had asked about, is this a fund of funds or in actual companies? And I think there's a differentiation there, right? The asset allocation portfolios are going to use funds to achieve that asset allocation, whereas the sustainability focus portfolio is going to own those individual stocks within the portfolio. I don't know if you want to expand on that anymore.
You nailed it on the head. That's exactly right. The asset allocation portfolios use third-party mutual funds and ETFs, whereas the sustainability moat focus invests in those 40 to 80 individual company names.
But I guess maybe the place that needs more clarification is that those 40 to 80 companies are dictated based on the Morningstar index, correct?
Based on the index, that's right. So based on those filters, so ESG risk rating, controversy score, product exclusions, and then there's the valuation overlay. So you have to have a wide moat, have to be in the top 80% of momentum. Once we get that universe down, we select 40 to 80 names within that space.
Hey, Brett, can you share your screen again and go to that slide that had all of the funds, the equities and the bonds? For Michael's question, I think this will really hit home. If you just go back a few slides, right there. Okay, so it's not a fund of funds, because what a fund of funds means, it would be a lot of these funds, and it would be one mutual fund. It would be one NAV. What you get at Morningstar is a portfolio of these funds. So we might own, 3% of the Domini Impact International. We might own 7% of the Brown Advisory. So your portfolio will consist of all these funds. So it's a portfolio of funds, to answer your question. And the other thing, Brett, maybe we could tell Morningstar to add this, I'd like to see is the cost of the funds and ETFs is very low. Your Brett showed the 20% equity and up 20% each. The expense ratios of these funds and ETFs they range anywhere from the low 30 basis points up to 45 basis points. So not even 0.5% for the fund expenses, which is considered very low. So that's another quality of a Morningstar portfolio, is that we buy institutional class shares and low cost ETFs. So the internal costs of the funds are very low. I'll stop there.
Very good, Steve. Yeah, I think those are important details. You know, and you know, if you are an existing client and this has raised questions about, hey, maybe should I explore these portfolios more, or maybe I'd like to dip my toe in a little bit, I would be happy to meet with anyone one-on-one to discuss kind of the pros and cons of where you are now, what we'd expect, and you know, talk through these different portfolios in a little bit more detail. So feel free to just email me if that's an interest point for you. I'd be happy to schedule a time.
We also at Morningstar, besides low cost, we also believe in accessibility, Josh, to all. Like, we don't have a high minimum of $100,000 to get into a portfolio. We have a $25,000 minimum. So for most investors, you know, you can have a part or all of your portfolio in ESG. And as a wholesaler, that I work with advisors like you, Josh, and you know, all of the state and other states, you know, it's becoming a small piece of portfolios. You know, it's becoming just a satellite piece to portfolios. So and then the equity minimum is 75,000. I just wanted to make that clear.
Okay, good point. Brett and Steve, did you guys have anything else to add? Or if anyone else has any questions, throw them in chat real quick. We'll try to address those. If not, we'll wrap things up here. I did definitely want to thank Brett for putting together the presentation today. Steve and I had the easy part of the job where we can just jump in and throw them off track. But Brett did all the hard work to put everything together. Yep. And for everyone attending, I see people are dropping off at this point, but I wanted to thank you. I've done 15 webinars, some with Morningstar, some by myself this year, but that's a lot of presentations staring at a camera on my computer. Yeah. So I thank you all for participating and for your feedback throughout the year. If there's any topics that you'd like me to address next year, certainly we're going to see which ones we had the highest attendance on and highest engagement. But if there's any new topics or points of interest that you'd like us to address for me or our partners at Morningstar, definitely let me know. I'd be happy to set up those presentations for next year. So thank you again, Brett and Steve, for joining me today. And thank you, everyone, for attending.
Thanks for having me.
Thanks, everyone.
Sure.
Happy holidays.
Happy holidays.